What is passive investing and what is active investing? What's the difference between the two and which one is better? That's what we're going to talk about in today's video. My name is Long and I'm an ETF Portfolio Manager. And throughout the span of my career so far, I've worked with active funds, passive, index funds, and now ETFs. And what I want to do is I want to make investing accessible by sharing my knowledge and experience in easy to understand terms to help you along your financial journey. So if you haven't already done so, subscribe. Check out my previous videos if you want to learn more about ETFs and how to get started investing. So the age-old debate, active versus passive. Why don't we start off by going through what is a passive fund and what is an active fund. Passive investing is when a fund mimics the benchmark or when it replicates the index methodology. Either way, the aim of a passive fund is to achieve the same returns as the index before costs and fees. So it's just like following a recipe to the exact measurements of each ingredient and the exact steps. Now, active investing, the main goal is to outperform the benchmark. It's a much more hands-on approach where the portfolio manager has to make decisions about the underlying positions of the funds, their weights, and even cash levels. This can be done by fundamental analysis, where you essentially get to know the stock or the company really well, its management and its sector, or it can be done by a quant model, where stocks are given scores based on their attributes or factors and characteristics. So going back to the recipe analogy, if passive means to just follow the recipe, then active means you believe that you can do better. So you might put some things in or take some things out, you might change the cooking time, or essentially just put your spin on it because you believe that your outcome will be better than just by following the recipe. So generally when we talk about passive funds, we're referring to funds or index funds that track broad market cap weighted indices. So they might include the S&P ASX 200, the S&P 500 index, or the NASDAQ 100. And usually there might be the likes of Vanguard, BlackRock, or by ETF issuers. On the other hand, active is usually a managed fund, and you will probably know them by their portfolio manager. Because when you're choosing an active fund, you are choosing the portfolio manager or the underlying investment strategy as opposed to the index. Generally, passive funds have lower fees than the active counterparts. That's because in an active fund, there's a lot more work involved to try to beat the benchmark. Passive funds are transparent and you know exactly what you're getting. For most passive funds, they update their fund holdings to their website on a daily basis, while active funds, they only update their holdings on a more periodical basis. But for a passive fund, because you are following the index, it means that you will only ever get the index return before fees and costs. It is very unlikely that your passive fund will beat the index. Now, as to whether that is a good or a bad thing is very subjective and depends on the investor's personal views. Active funds have more flexibility in terms of their holdings and how they manage the fund and the trading side of it. So what that means is that you can adapt to current market cycles and you can do so very quickly. But because of that, and because of the portfolio manager's skills, it means that active funds are more expensive usually than passive funds because they try to beat the index. But at the same time, you have to remember that outperformance, or any performance for that matter, is not guaranteed. So which one is better? That is the question. And I would say it depends on who you ask. So if you were to ask Warren Buffett, the CEO of investment firm Berkshire Hathaway, who is also known as or considered one of the greatest investors of all time, he is a big and firm believer of index funds. He believes that low-cost index fund is the most sensible form of equity investment for the greater majority of investors. In his shareholder letter in 1993, he said that by periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. And the main reason behind that is, can you guess? Fees. So not only does the active manager need to have the right call in terms of what positions and what stocks to hold, it needs to physically execute that. And by doing so, the active fund generally incurs more costs compared to an index fund that just holds and tracks the index, which generally has a lower turnover. Now, I'm sure that you've all heard of what I'm about to say before, and that is compounding is the eighth wonder of the world. Well, guess what? Compounding actually works in both ways, and that is it can add to your long-term returns or it can detract your long-term returns in the form of fees. So here's a little tip for you. When it comes to investing, what you want to do is you want to maximize your returns post-fee and post-tax, because at the end of the day, that is what is going to get into your pocket. No, and it's not just Warren Buffett, the greatest investor of all time, saying that, so that's why you should believe it. There is also something called the SPIVA report, and that is the S&P index versus active report. And the SPIVA report measures the performance of actively managed funds compared to the respective benchmark over different time periods and for different funds. So can you guess, in the year of 2022, let's just say all Australian equity funds, what is the percentage of active funds that underperformed passive funds? I'll give you a second. 58%. So according to the SPIVA 2022 Australia scorecard, 58% of active funds underperformed the S&P/ASX 200 index. And if you were to extend the time horizon, that percentage of funds that underperform the index or the S&P/ASX 200 goes to over 80% if you were to look over 15 years. So what that means is, let's say you're in a room by yourself and you are the index investor. You just invest in an ETF that invests in the S&P/ASX 200 index. And alongside you in that room are 10 active portfolio managers. They're investment professionals who claim that they're really good at their job and they can actually beat the benchmark. And guess what? Over 15 years, 8 of them would have lost, or you would have outperformed 8 of them. But of course, there are instances where an active investment or an active fund may be a better option for you. So for example, the type of exposure that you want for your risk profile or for the investment returns that you're after is just not available via a passive fund. So then you might have to seek that option via an active fund. Or if you were to think about it in terms of a core satellite allocation, you might use the core of your portfolio, use an active, and potentially use an active as a satellite position. So even then there is research or numbers from the SPIVA report that point to that you probably are better off just holding an index fund that tracks a broad market cap index such as the S&P/ASX 200. At the end of the day, I think it really depends on you and the amount of effort and what you're after in terms of risk and return. Some people just want exposure to the market. They just want to get started investing, or they just want to set and forget, and they just want to ride along the wave or ride along with the index. Then sure, maybe a passive is a better option for that person, while others might want to take matters into their own hand. They might enjoy doing the research, or they might enjoy reading the papers and making those calls. So that's maybe in that case an active, or they are the active manager. So even though I always say this, but at the end of the day, it really depends on you, what your personal investment goals are and your risk profile, and what your preference or how you want to handle your investments are. So let's do a quick recap. So passive investing is when you mimic or try to replicate the benchmark and its returns before fees and costs, while active investing is when you try to actively beat the benchmark. Most ETFs are passive ETFs, but there are also active ETFs. And even though an ETF is passive, it doesn't always mean that it's a passive index ETF that tracks the broad market cap weighted index. That's why it's really important to always understand the ETF, look under the hood, and to know what kind of exposure you're getting yourself into. So for example, thematic funds, ESG funds, or special sector funds, they're not really your broad market cap index ETFs where you get the same returns as the whole equity market. So even though a passive ETF is following a recipe, the recipe may not be for a vanilla sponge cake or your broad S&P/ASX index. It might be something really funky or exotic, like a triple caramel fudge chocolate brownie or something. That's why it's always important to, read the box of the recipe and understand the index methodology and what you're getting yourself into. Anyways, I sidetracked a bit there. But if there's one thing I want you to take away from this video, is that for you as an investor, what your main goal is to maximize your returns post-fees, post-tax. And that's it for today. Thank you for spending your time to watch this video. Remember to like and subscribe. You can also find me on other social media channels such as Instagram and TikTok under the handle The Long Way. Stay tuned, because in the next video we'll talk about different types of exposures that you can get via ETFs and the different asset classes as well. So see you next time.